Joining us now is someone who focuses a lot on that macro environment as he invests in real estate around the world. He is Hines Global CIO, David Steinbach. David, thank you so much for being with us. I want to start there. We've talked a lot about how rates can remain where they are simply because nothing is breaking. The U.S. economy is doing just fine, so maybe this is the neutral rate. Do you think that we can see a real estate recovery at a time where rates may not go down at all?
I do. I think it's important to remember that we're almost 40 months into rates going up in the U.S. and a lot of markets around the world. And that's a very long time. And the bid-ask spread has been quite wide for quite some time. And so even in this moment, if rates stay neutral or even tick up a little bit, I think the market has digested where we are right now. And really, at least when we're underwriting projects, are very much focused on how we can drive rent growth in our buildings, increase cash flow, and we're reducing the amount of leverage we're putting on assets as well.
Hold on a second. You said something that I need to dig into. You think that this market is actually stabilized and adjusted to it. A lot of people think that the real estate market's completely broken. You're not seeing transactions. People aren't able to borrow money to buy homes. Do you think we've already seen the bottoming out, the washout, particularly in commercial real estate that some people are talking about?
I think we have seen the bottom, yes, in the U.S. I think this year we're going to see capital that is on the sidelines begin to come in. I think certainly here in Davos, everything I'm hearing is every marginal dollar around the world is looking at the U.S. as a significant opportunity. And again, we've had 35 months of the market being able to have that price discovery, and we've been waiting a long time. And I think this year is the year that we'll see a lot of activity.
We've seen a lot of activity in specific slices of the market. Data centers, we see this in warehouse spaces. We haven't seen it in, say, office spaces, particularly in second and third tier cities. And I'm just wondering, do you think that maybe it's gotten a little lopsided, that that area that's been very popular stands to become less so and maybe money flow into the office space? I
think there's still a big opportunity in data centers and industrial. Those have been big themes that have obviously carried the day for a long time now. And I think there's a lot of tailwinds that are really important to realize. I think for us, living is a top sector for us. The U.S. is about 2 million houses short, and we believe there needs to be a lot of new building that will happen. Retail is now a sector that we are very focused on. It has been challenged for so many years that the winners and losers have been sorted. And office for us actually is something that we are starting to look at. We're starting with credit in office today, but I could see as the year progresses us moving into equity.
So this is mostly in the U.S., you're saying?
Correct.
And I'm just curious, you talked about the multifamily homes or single-family homes even in this idea of renting. And I wonder how much this is a structural change. We've seen, given the rise in rates and the increase in prices, there are a lot of people are locked out of home ownership. And we've seen an increase in renting, just structurally, and a decrease in home ownership. Do you think that that is a structural change that will continue to accelerate, even if, say, rates do go down, mortgages become more affordable?
I do believe there's some key demographic changes that are happening broadly in the West. It's happening in Europe, Australia, but also in the United States. And I think those demographic changes are also impacting what you're talking about. I do think openness to rental does give, there's certainly positives to it for a lot of people. And I think that the market needs to provide more rental housing that is attainable, and I think that's going to happen.
Do you think that there's actually more room to run in terms of raising rents? And I ask this because that's a main component of CPI, of the main inflation gauge that looks at consumer prices, and I'm wondering if that actually stands to increase.
More broadly, I'm concerned about longer-term inflation across many different sectors. So it's not only rental rates, it's other parts of the economy as well. I also think that there will be new corridors of demand that open up within cities. And so while rental rates obviously aren't going to be able just to infinitely go up in certain markets, but what we're seeing because of the demographic shifts, people are moving around and spreading out a little bit. And I think that's good for the market, and I think that will help provide more attainable housing as well.
One thing that's been a theme here at Davos is U.S. versus Europe versus the rest of the world. And one thing that's kind of ironic is the more that people get excited about the U.S., the more they note that it's priced to perfection. And wait a second, maybe we should look elsewhere because they stand to do better, even if they just don't miss as much as people thought. Are you one of those who actually start seeing more opportunity in places like Europe?
We do invest money around the world. So we are an active real estate investor. We're in 30 countries, and we look at all the countries as where the opportunity is. Asia for us is our growth stock, and so we will stay active there. U.S., we will be putting a lot of capital to work in the U.S. I do believe that this is a great time. But Europe, what's interesting here in Davos, the negativity around Europe is it just cannot really be that bad. And I don't think so. And I think that, we have raised a substantial amount of capital that we're ready to deploy in Europe, and we will do that this year. We are going to be very selective, but when I hear capital pull back from a geography, it feels that way here at Davos. I don't think it'll end up being quite as bad as the sentiment is.
Are there particular regions that you're looking at more closely? And I say this at a time where the economic engines of Europe are actually sort of the sick dogs, and the ones that were the sick dogs are kind of the economic engines. I mean, are you following that trend?
It is interesting to see how Europe has behaved this cycle versus the financial crisis. In the financial crisis, it was really Northern Europe that had much more strength compared to Southern Europe. This time, it feels a little bit inverted. In terms of Southern Europe, for us, there's a lot of interesting activity right now in Spain and Italy and other places in those geographies. With that said, I do think that with the capital pullback, very interesting opportunities are going to open up in Germany. We're active in the UK as well. I think all those geographies will provide unique deal flow.
You mentioned the UK, and one theme that's come up again and again is just the debt and deficits of a lot of places. And I know as a homeowner that often the first place they go to is taxes on your home. And how much are you looking at some of these policies as a potential headwind to certain investments in certain places? I
think some of the headwinds you're mentioning are fairly ubiquitous in a lot of markets. You can add insurance to that. You can add, there's a lot of pressures on cost everywhere. And I think that is something that investors are broadly going to have to get their head around because it's impacting a lot of sectors. It's not just real estate, it's the broad economy. And further, I think the debt levels in many of the Western countries are going to put more pressure on interest rates in the long term. And so I think as we invest today, particularly in real estate, it's a longer term investment. You have to think about that horizon. So what's your sort of base case or your stress tests in terms of the range of rates where you still are going to be above water? We are using very conservative leverage now, and I think that's a little bit different than previous cycles where there was a bit more leverage in the system given the cost of capital. So we're being very conservative with leverage, and we're focusing very much on how much cash flow we can create when we actually make an investment. Predicting exactly where interest rates are going to be in 5 to 10 years is close to a fool's errand in terms of what's actually going to happen. But really preparing your capital stack for a range of outcomes and relying on income, relying on the actual real estate you're buying, that's what's most important. So you mentioned Asia. Not going to let that go. Are you headlong into China, given the fact that real estate there seems to be on sale? We have been in all those markets for a long time, including China, and we've had a lot of successful projects there. We right now are mostly focusing on India right now as the major growth component for Asia. China needs a bit more time, but India right now is where all the tenants that we have spoken to have really shifted into significant growth expansion mode, and that's where we're seeing most activity. So are you staying in China? Do you think that there's still opportunities there? Yeah, we're a long-term investor, and again, we've been in China for over 25 years, and I think you have to see the long term. But for us, again, right now, we're going to be mostly focused on India. What's your main takeaway from Davos this year? Well, it's interesting. I've been here several years, and I think the optimism here is palpable. And I think my only concern is when it's that positive, can it really be that good? So I'm actually feeling a little more just curious to ask some harder questions. But without question, I think 2025 is going to be a good year. David Steinbach, thank you so much for being with us. David Steinbach of Hines, which oversees more than $90 billion